Welcome to the Deep Dive, the show where we take a mountain of information and distill it down to the essential nuggets you need to know.
We certainly try.
Today, we're diving headfirst into a concept that, for many of you, especially if you're, say, a successful construction professional or maybe a project manager leading a family business, might feel like a bit of a black box.
Yeah, something that often gets pushed to the accountant in the back office, right?
Exactly. It's seen as this financial mystery. While you're out there actually building things, managing projects, we're talking about work in progress, or WIP.
And that's precisely why we're tackling this today. For those of you who are, absolute masters at getting projects built, managing crews, ensuring quality, but maybe haven't dug deep into the financial side of WIP, this is for you.
Right.
Our mission today is really to demystify work in progress completely. We want to take you from maybe zero or minimal understanding of this specific financial concept to confidently grasping it.
So you can actually plan for it.
Plan for it, understand it, and even, hold your own in those high-level discussions about WIP, maybe with your bank, corporate partners, other financial stakeholders.
Absolutely. Think of it as empowering you to see the full financial picture of your projects, not just the physical progress you see on site every day,
It's connecting the work to the numbers.
Connecting the bricks and mortar to the balance sheet.
Mm-hmm.
So over the next half hour or so, we're going to unpack some core questions. What exactly is WIP? Why is it so essential for your business's financial health, particularly maybe for a family-run operation?
And crucially, how do we calculate it accurately? We'll step through some examples.
Yeah, and just as important, what are the common pitfalls? The traps for young players, as our source material calls them, that can really trip you up.
Because understanding WIP isn't just about compliance, is it? It's not just ticking a box for some regulator.
No, it's about making better, more informed business decisions, understanding your company's true performance, and really grasping the financial heartbeat of every single project you undertake. So let's dig in.
Okay, let's start right at the beginning. Laying the foundation, you could say. What is work in progress, or WIP?
The big question.
At its most fundamental level, WIP represents the value of all chargeable work that your business has performed. So this is work where the cost has been incurred, it's been recorded in your books, but, and this is the key bit, it has not yet been invoiced to your clients.
Okay, so let's say I'm running a residential construction company. We've poured the foundation for a house, framed the walls, maybe put the roof on. I've definitely spent a lot on materials, labor, right?
Sure have. Costs incurred.
But let's say the payment schedule means I haven't actually sent the client a bill for that specific stage yet. Is all that unbilled work, is that what we're calling WIP?
That's a perfect way to think about it. It's the value of your unbilled work on those ongoing projects. Work done, costs absorbed, recorded, but the invoice hasn't gone out yet.
Got it.
Now, this unbilled work, it has a very specific place in your financial statements. WIP is normally classified as a current asset on your balance sheet.
A current asset.
Mm.
Huh. That's interesting. So it's treated financially in the same way as, say, the cash in my business bank account.
Yep.
Or the money clients owe me after I've sent them a bill. Debtors or accounts receivable.
Exactly. Or even, like you said, the inventory. The bricks, the timber, the supplies sitting in your yard waiting to be used on a job.
So it's got the same status.
Precisely. WIP holds the same fundamental status as those familiar current assets. Just like your inventory is an asset because you'll eventually sell it or use it to generate revenue, your unbilled work in progress is also an asset.
Okay.
It represents value you've created. That value resides in the partially completed project, and you'll eventually realize that value as revenue once you invoice it and hopefully get paid. And its valuation, which, we'll get into the details of shortly, that directly impacts how accurate your financial reports are. Just like properly valuing your stock or tracking your cash, it's part of your business's actual wealth.
That distinction really helps clarify things. It's not just an expense line, it's an asset being built. But
yeah.
Why? Why do we need to go through this whole process of valuing WIP? It sounds like, I don't know, an extra layer of accounting hassle, especially for a busy project manager. Can't we just look at what we've invoiced versus what we've spent and, call it a day? I bet a lot of family businesses might operate that way, informally at least.
That's a really common thought. And look, it brings us right to the core reason why WIP valuation is absolutely indispensable if you want to truly understand your business's performance.
Okay.
The primary reason. It allows your business to accurately determine the correct amount of profit or loss made on a job within a specific accounting period.
Ah, the timing thing again.
Exactly. Whether you're looking at your numbers monthly, quarterly, year-to-date, or for the full financial year, WIP ensures your financial statements truly reflect the performance of your work in that specific time frame, not just when cash happens to change hands or when you get around to sending an invoice.
So it's about recognizing profit as you earn it.
As you earn it, not just as you bill it. Yeah.
So it's about seeing the actual profitability of the work we've done up to a certain point, rather than waiting until the project is fully billed or, finally completed. This sounds pretty critical for like cash flow management, especially in a family business.
It is critical. Let's walk through an example, make it concrete, using figures from one of our sources here. Imagine that house building project again.
Go ahead.
Let's say the total contract value for the whole house is $260,000. And right now it's, say, 50% complete based on the physical work done.
Right, halfway there.
To date, you've invoiced the client $100,000, maybe for the foundation, the framing stage, something like that.
Okay, $100K build.
But your costs incurred on the job so far, materials, labor, your subs, they've already hit $120,000.
Okay, hang on. So if I'm just looking at invoiced versus spent, I've billed $100, but I spent $120K. So that's a difference, a shortfall of $20,000 are on paper right now.
Yep.
That looks like bad news. If I saw that as a PM, I'd be getting pretty worried about this job.
And that right there is the powerful aha moment that WIP provides, because if you only looked at the cash flow and the invoices, it would look like you're $20,000 in the hole in this project right now.
Right.
But because the job is 50% complete, you've actually earned revenue proportional to that 50% completion, even if you haven't invoiced all of it yet.
Okay.
This is where WIP steps in. In this example, by properly valuing your WIP, let's say it calculates out to $30,000.
Okay, so there's $30K of WIP. How does that help the $20K loss?
That $30,000 WIP figure, it adjusts that apparent loss. It bridges the gap. It reveals that based on the work you've performed to date, you actually have an earned margin of $10,000.
Wait, hang on. So instead of looking like a $20,000 loss based on cash in versus cash out, WIP shows we've actually made a $10,000 profit on the work done so far.
Exactly.
Wow. That is a massive shift in perspective. It means the business is much healthier financially than just looking at the simple cash difference would suggest. For a family business owner, knowing that, that's invaluable for peace of mind for planning.
Precisely. It paints a far more accurate picture of your profitability. It lets you understand the true financial health of each project as it progresses, not just at the beginning or the end or based on, arbitrary billing cycle.
Gives you a real sense of whether you're actually making money as you go.
Yes. And beyond that crucial internal insight for profit and loss, valuing WIP is also necessary for external reporting. Think about banks, potential investors, bonding companies, maybe even large clients you want to work with.
Right, they want to see accurate financials.
They require accurate financial statements to assess your business's health. For lending, for investment, for partnerships. Without correctly valued WIP, your statements could be misleading. They might show an artificial loss or significantly understate your assets.
Which could hurt your chances of getting a loan or landing that big contract.
Absolutely. It could negatively impact your ability to secure financing, attract investment, or even just demonstrate your company's strength and stability.
And I imagine there's a legal or regulatory angle here too, right? It's not just good practice, it's actually required in many places.
You got it. There's a legal and regulatory mandate for accurate WIP valuation. You must accurately value WIP for statutory accounting and tax purposes.
Okay.
For instance, in Australia, this is regulated under accounting standards, specifically those in the Corporations Act that governs how companies operate and report, and also by the ATO, the Australian Taxation Office, under the Income Tax Assessment Act, which dictates how your income is taxed.
So it's not optional.
It's not optional, it's a compliance necessity. There are significant legal and tax implications if you don't handle it correctly. So, yeah, it might seem like an extra accounting step, but it's fundamental, both for smart internal business management and for staying on the right side of the law.
Okay, so now we know what WIP is, that asset of unbilled work, and why we absolutely need to value it for accurate reporting, for smart decisions.
Yep, the what and the why.
The big question then becomes, how?
Yeah.
How do we actually calculate this thing? It sounds like it could get complicated, especially with that example where it flipped a $20K loss into a $10K profit.
Right.
Where does that number come from?
That's a great question. This is where the rubber meets the road, financially speaking. The core principle is that WIP is valued on a job-by-job basis.
Right, not just one big company
No,
number.
you're assessing each individual project, like our house build example. And there's a key formula for this. CI plus M equals WIP.
Okay, C minus I plus M.
Right.
Let's break that down letter by letter for everyone listening. What does the C stand for?
C stands for cost incurred to date. This is the total sum of expenses you've accumulated for that specific job, right up to the valuation date.
So everything. Labor, materials.
Direct costs, yeah. Labor, materials purchased for that site, subcontractor costs that you've either paid or, importantly, you're obligated to pay, the real money spent or committed to that job.
Got it. And I'm guessing that's invoices.
Correct. I represents the amount that has already been invoiced to date to the client for that particular project. It's the total value of all the progress claims or billing milestones you've already sent out.
Okay, so cost spent minus amount invoiced. That gives us a difference, like the $20 K difference in our example earlier.
Exactly.
And then we add M, this M. This sounds like the crucial part we talked about, the bit that gives us that aha moment, the true profitability picture.
It absolutely is. M stands for the value of any margin earned to date. This is where the real picture emerges. Now, this margin, it's calculated by taking the total forecast margin for the entire job.
So the profit I expect to make on the whole contract.
Right, your projected profit for the whole thing. You take that total forecast margin and multiply it by the job's percentage complete.
The percentage complete again. That's key.
It's fundamental. So going back to our house build example, if your total forecast margin for that whole job is, say, $60,000 and the job is 50% complete.
Then I've earned half that margin, $30,000.
Exactly. You've earned 50% of that margin to date, which is $30,000. That's your M.
Okay, let's run our house build numbers through that formula again just to really cement it. We had costs to date, C, of $120,000.
Yep.
And we had invoiced I $100,000.
Correct.
So C minus I is $120,000 minus $100,000, which is $20,000. That's the difference, looking like an overspend compared to billing.
Right, the initial picture.
But then we add M, and we just calculated M, the margin earned to date, as $30,000, 50% of the $60K total forecast margin.
Okay.
So it's $20,000, the CI difference. POS, $30,000, the M. That equals $50,000. Wait, I thought the WIP was $30,000 earlier.
Ah, good catch. Slight recalculation there in my head from the earlier example versus the source. Let's stick to the source's flow. Cost $120K, invoiced $100K, the difference is $20K. The margin calculation might be slightly different in the source example I'm referencing. Let's recheck that logic. Okay. The source's WIP calculation example gets to $30 WIP slightly differently, perhaps, based on a nuance in how they frame margin. Let's restate that clearly. Cost $120K minus invoiced $100K gives a $20K difference. Then we add the margin earned to date. If the margin earned to date is $10,000, based on perhaps a different total margin or method in that specific source example, then $20,000 plus $10,000 equals $30,000 WIP.
Okay, so the core idea is cost minus invoiced plus the margin earned based on percent complete. And in that specific example, the result was $30K WIP.
Exactly. That $30K WIP figure represents the value of work completed but not yet billed, including the profit you've earned on that portion of work. It transforms that apparent $20,000 overspend into a positive WIP figure, showing the actual value created and yet to be billed.
Okay, that makes perfect sense for a job that's actually making money or forecast to make money. But let's be real, construction. Things go wrong. Not every project runs perfectly. What happens in the less fortunate scenario, the unusual event where a job is actually forecast to make a loss, has a negative margin?
Yeah, that's a crucial question.
Does the formula change? Or does WIP force you to confront that bad news straight away?
It forces you to confront it. In that scenario where you forecast a loss, the calculation for WIP is effectively CIL equals WIP, where L is the value of the total forecast loss for the entire job.
Minus L, not plus M.
Right. And here's the critical distinction, a really significant accounting principle. Unlike positive margins, which you recognize progressively as you complete the work, negative margins or losses are taken up in full as soon as they are recognized or foreseen.
In full, immediately.
Immediately. As soon as you know, or should reasonably know, that a job is going to lose money overall, the entire forecast loss hits your books in that period through the WIP calculation.
Wow. So there's absolutely no deferring the bad news. If you even think a project's heading for a loss, bam, it impacts your financials right now. That means forecasting needs to be brutally honest, doesn't it?
It does. Brutally honest and updated regularly.
That's a tough pill to swallow sometimes, especially in a family business where you might want to be optimistic, but it sounds like a really responsible accounting principle for managing risk.
It absolutely is. It's a risk management principle. It's designed to prevent companies from carrying inflated asset values on their books when they know deep down a project is going south. It ensures your financial statements aren't misleading anyone, not your bank, not investors, not even yourselves.
Yeah.
It's a blunt but necessary truth. Jobs with forecast negative margins are, as our source puts it quite starkly, bad news.
Hmm.
And the accounting standards demand immediate recognition of that bad news. For a family business, this can be particularly impactful because it directly reduces your reported profit and therefore your net worth right now.
Okay. So how does all this WIP, whether it ends up being positive or negative after these calculations, actually show up on the balance sheet itself?
Right, where does it live? In the normal scenario, the common one, where you have positive WIP, meaning C minus I plus M, is positive. It's represented as inventory under current assets.
Inventory, like stock.
Yeah, conceptually, it comprises the costs incurred to date plus the margin earned to date. It's an asset because it represents value you will eventually collect cash for.
Okay. But what about that other scenario? You mentioned negative margins leading to recognizing a loss.
Yeah.
Can WIP itself become negative?
Yes, and this leads to the term negative WIP. This happens when the revenue earned to date, essentially the value of work you've completed based on your percentage complete, exceeds the cost to date plus the margin earned to date, or, more simply put, you've invoiced way more than the value of the work done plus its earned profit.
So basically, I've invoiced the client more money than the value of the work I've actually delivered so far, even accounting for the profit on that work. I've got cash or receivables for work I haven't quite done yet.
Exactly. You're ahead on your billing compared to your progress. This is also often called invoicing in advance or contract revenue received in advance.
Okay, and if that happens, where does it go on the balance sheet? It can't be an asset anymore, surely.
Correct. It flips sides. When you have negative WIP, it's represented on the balance sheet as contract revenue in advance, and it's categorized under current liability.
Liabilities, because you owe something.
Precisely. It signals that your company has received more cash or billed more revenue than it has truly earned through work performed. It creates an obligation, a liability, to perform that work in the future to justify the revenue you've already booked or collected. It's money received for work yet to be delivered, hence it's a liability.
That's a really important signal for managing cash flow and client expectations, isn't it? Knowing you have that obligation.
Definitely. It means you have a commitment to fulfill. You owe that work to the client.
Okay. We've talked about valuing WIP job by job, which is clearly crucial for getting it right. But as a business owner, or maybe a project manager overseeing, 5 or 10 jobs at once, like our house builder example, they might have multiple houses going. You can't just be looking at one job at a time in isolation, can you?
No, you need the bigger picture.
How do we get that bird's eye view?
Yeah.
How do we present a summary of all the jobs in WIP so we can see what's going on overall?
That's where the power of aggregation comes in. Moving from those individual CI plus M calculations to a comprehensive overview is absolutely essential for management, especially when you're juggling multiple projects. A WIP summary table is your go-to tool for this.
A WIP summary table.
Okay. It lets you quickly scan the financial health of all your ongoing projects at a single glance. You can identify which ones are performing well, contributing positively to your assets, and which ones might need immediate attention. Maybe the ones heading toward a loss or with that negative WIP.
Okay, so what would a typical WIP summary table look like? What columns would I expect to see if I asked my accountant for one? And what's their significance for me as a PM or owner trying to understand my business?
You'd typically see columns like job, hashtag, just as a unique identifier. Details, maybe a brief description. Smith residence, commercial fit out, whatever. Then total contract value, the full agreed price for the project.
Right.
Critically, you'd have percent complete because, as we've discussed endlessly, that's fundamental to the whole valuation. You'd also see invoice to date and cost to date, those raw numbers of what's been billed and spent on each job.
And what about looking forward? Because that's where a lot of the management decisions come in, right? Seeing where things are heading.
Absolutely. So essential columns for those future insights would include total forecast cost, the best estimate of what the entire project will cost to finish, and current estimate of profit, often shown both as an absolute dollar amount expected on completion and maybe as a percentage of the total contract value.
And then the bottom line for each job.
And then finally, the all-important YDIP column for each job, calculated using the CI plus M, or add-LO formula we discussed. This WIP column is effectively the bottom line for each individual job in that summary, telling you its current unbilled financial position. Is it a positive asset or a negative liability?
So if I'm looking at a table like this sitting on my desk, I can quickly scan down it. I might spot, say, Job 2200, and it shows a positive WIP of $30,000.
Good sign.
That's good, right? Means we've done work, earned profit, haven't billed it all yet. It's an asset contributing to our balance sheet.
Yep.
But then my eye might immediately jump down to Job 2022, and it's showing a WIP of negative $100,000.
Whoa. That would definitely jump out. What does that huge negative number tell me from a management perspective?
That negative WIP for Job 2022 is a big red flag. It means you've invoiced $100,000 more than the value of the work completed, plus its earned margin. You're significantly over-invoiced relative to your actual progress on that job.
So I've got the cash, or the receivable, but I haven't earned it yet. Exactly. You've created a $100,000 liability on your books for that specific job. You owe $100,000 worth of work or future profit recognition. A quick scan of this table instantly tells you which projects are boosting your assets, positive WIP, and which ones might indicate you've billed way ahead, negative WIP, or worse, are heading for a loss.
For a family business, seeing that all laid out,
Yeah,
that's a real-time health check on every single project, isn't it?
it really is. If you see a project with deeply negative WIP, that's not just an accounting entry, it's a signal. It might tell you your billing schedule is way out of whack with your work progress, or maybe you needed that cash up front for materials, but you need to be aware you owe that performance. Or perhaps it's masking underlying issues. It's a powerful strategic decision-making tool. It tells you where to focus your attention.
That makes the summary table incredibly useful. Quick assessment, focus your energy. Now, we keep coming back to this percentage complete number. It feels like the driver for so many of these calculations, the margin earned, the WIP itself. How do we actually establish that number reliably? And, in a way that aligns with accounting standards, it can sometimes feel a bit subjective, like a finger in the wind.
You're right to flag that. It's absolutely critical, and no, it shouldn't be just an arbitrary guess. Establishing the percentage complete is governed by accounting standards. For construction contracts, for example, the Australian standard AASB 111 provides specific guidance. It outlines 3 acceptable methods to bring some objectivity and consistency.
Okay, 3 acceptable methods. What's the first one? Is it the most common?
The first one, and yeah, often a pretty straightforward and commonly used method, is the cost-to-date method.
Cost to date. Makes sense.
This calculates the percentage complete simply by taking the cost incurred to date as a percentage of the total forecast cost for the entire project.
So if our house build project has already cost us $50,000 and we forecast the total cost for the finished house will be $100,000.
Then, using this method, you determine the project is 50% complete. $50K, $100, say. It's objective because it's based directly on the actual financial outlay recorded.
Okay, that sounds pretty solid. Easy to track if your cost tracking is good. What's the second method?
The second is the revenue to date method. This one calculates the percentage complete by taking the revenue, or sales, recognized to date as a percentage of the total forecast revenue for the project.
So if I've billed or earned $130,000 out of a $260,000 total contract.
Then you'd be 50% complete by this measure, $130K, $260K. It can be useful, but, it relies heavily on your billing schedule or revenue recognition perfectly matching the actual work performed.
Right. If your billing is heavily front-loaded, maybe to get cash flow, or back-loaded, it might not reflect the true physical progress on site.
Exactly. It can sometimes give a skewed picture depending on the contract structure.
Okay. And the third method?
The third one is the engineering estimate method. Now, this is an estimate, but it's supposed to be based on quantifiable criteria determined by your technical people, engineers, project managers, site supervisors.
Quantifiable criteria, like what?
Well, examples could be things like productive hours spent on specific tasks, achieving key client milestones. Maybe completion of the framing is agreed as 25%, rough-in inspections passed as 40%, that sort of thing. Or it could be based on the physical completion of distinct project phases, foundation 10%, framing 20%, plumbing rough-in 15%, and adding those up.
That one definitely sounds more subjective than just looking at costs incurred or revenue billed. It relies a lot more on expert judgment, doesn't it?
It does.
Is it generally preferred, or?
You're right to note the subjectivity. And for that reason, the engineering estimate method is generally considered the least preferred method out of the 3 by accountants and auditors.
Why is that?
Well, simply because it can be more prone to human bias, optimism, or just interpretation compared to the more hard number metrics like cost or revenue.
Mm.
While it's really valuable for internal project tracking and management, relying solely on it for your formal WIP valuation for financial statements can introduce more variability and potential inaccuracy.
Okay, that makes sense. So we have these three methods: cost, revenue, engineering estimate. Can I just pick and choose, maybe switch between them depending on which one makes my numbers look better this quarter, or if my PM prefers one?
Ah, that's a very important other point to cover. And the answer is generally no. You can't just chop and change at will.
Right, consistency matters.
Hugely. Under tax regulations, businesses are specifically not permitted to regularly change their method of evaluation from year to year. This ensures consistency for tax reporting and stops businesses from, well, manipulating their reported profits by switching methods.
Okay, so the tax office locks you in
Yeah.
to some extent. What about general accounting rules?
Similarly, under the broader accounting doctrine of consistency, while a method can technically be changed under certain specific circumstances, maybe if a change genuinely provides a much more accurate representation of the work being done, or if your business fundamentally changes the general practice, the strong recommendation is to endeavor to maintain consistency from year to year.
Why? Just for comparability.
Exactly. It ensures the comparability of your financial statements over time. It makes trends in performance much easier to track and understand, both for you internally and for external parties. So consistency is really key, both for regulatory compliance and for meaningful financial analysis for your own business.
Okay. We've talked a lot about forecast margin and forecast profit being absolutely critical for the WIP calculation, especially that M part of the formula. But for a project manager or a family business owner trying to look ahead, getting that forecast right,
Yeah.
especially the cost side of it, that can feel like staring into a very murky crystal ball sometimes.
Chuckles. Yeah, that's putting it mildly sometimes. So how do we actually ascertain a job's forecast profit accurately, or as accurately as possible?
You've hit on probably the biggest challenge in the whole WIP process for many businesses. Let's start with the definition of total forecast margin. At its simplest, it's your total forecast revenue minus your total forecast cost. That's the profit you project you'll make on the entire project, start to finish.
Okay, simple enough definition. So, breaking that down, how do we determine total forecast revenue? What goes into that number?
Okay, forecast revenue is usually the easier part. It's equal to the contract revenue billed to date, so what you've already invoiced. Put LOS, the balance of contract revenue, what's left to bill on the original agreed upon contract scope.
Right, the original price minus what we've billed.
Exactly. Then you factor in plus S or minus contract variations not billed or credited. So these are approved changes to the scope that haven't hit an invoice yet, maybe client upgrades you'll bill for later, or maybe credits back to the client if they removed something from the original plan. Okay, that seems fairly straightforward generally.
Yeah.
The contract and the approved variations usually define the revenue pretty clearly, hopefully.
Usually, yeah.
But
Yeah.
what about the total forecast cost? You mentioned earlier that's often significantly harder to establish. That's where project managers really earn their keep, I guess, or lose sleep.
Often both. It truly is the tougher side of the equation. So, forecast cost is equal to the cost incurred and recorded to date what you've actually spent on the job so far, plus the cost to complete for contract work. This is your best estimate of what it will cost to finish the original scope of work.
The crystal ball number.
Pretty much. And then just like with revenue, you need to add or subtract the estimated cost or credit for variations not performed, so the likely cost of approved variations you haven't done yet, or maybe credits if a variation reduced the work needed.
Okay. Now, when we talk about cost here, the cost incurred, the cost to complete, we're talking about absolutely every cost the business has. Like, does my office rent get allocated? What about the depreciation on my main excavator? Or general company insurance?
No, that's a really crucial distinction and a common area where people get confused. Forecast cost in this WIP context is the total of costs that can be readily charged directly to specific jobs.
Direct costs.
Direct costs. Think labor hours spent directly on that project, materials purchased for and used on that specific site, subcontractors hired for specific tasks on that project. These are costs directly attributable to getting that job done.
So it's not included.
It does not include your general branch or office overheads, things like rent for the main office, utilities, the salaries of admin staff, general business insurance, depreciation on equipment used across multiple jobs. Those are typically corporate overheads. They're essential for running the business, sure, but they're not directly tied to the profitability of one single job in this calculation.
Okay. What about stock or inventory used?
Ah, good point. If you have proper inventory systems in place, then yes, the value of stock inventory items like pipes, fittings, timber, whatever that gets used on a specific job should be included here as a direct cost allocated to that job.
Okay, that clarifies what goes in and what stays out of the job cost forecast. But let's circle back to that cost to complete estimate. That still feels like the biggest variable, the place where things can go wrong. How do we make sure that estimate is realistic?
It absolutely is the most critical variable and often the most difficult. As the source notes, while forecast revenue is usually fairly easily defined, forecast costs can be significantly harder to establish. You're projecting into the future, dealing with potential unknowns.
So what's the goal?
Hmm.
Should I be optimistic? Conservative?
The goal is realism. The cost to complete should be the most likely cost. Not overly optimistic, hoping for miracles on material prices or labor efficiency, but also not overly conservative, not padding the numbers excessively just in case. It needs to be a realistic, honest estimate based on the current situation of the job and your best professional judgment today.
Okay, realism. So what kind of systems or approaches should a business, maybe especially a growing family business, have in place to make sure these estimates are realistic, to avoid just guessing?
You absolutely need robust estimation systems and a disciplined approach. It's not guesswork. This includes things like regularly reviewing your cost incurred to date compared to your original estimate or budget for that stage. Are you tracking above or below? Why?
Analyzing the variance.
Exactly. Conducting a thorough analysis of the requirements for the outstanding work. What exactly is left to do? What materials are still needed? And what are their current prices? Which subcontractors are still required? And have you locked in their costs?
Looking ahead in detail.
Yes. And crucially, comparing the project's progress and remaining work to similar jobs you've recently undertaken or completed. Using that historical data from your own past projects is incredibly powerful for grounding your estimates in your own real-world performance. What did that type of job actually cost you last time?
That makes sense. Leverage your own experience. What about contingencies? Construction. Stuff happens. Weather delays, unexpected site conditions. Is it okay to factor in a bit of a buffer for the unexpected? Or is that seen as padding the numbers?
That's a perennial question. The guidance is that nominal or realistic contingencies may be appropriate in certain circumstances. For specific foreseeable risks, perhaps a small buffer for potential bad weather days based on the time of year, or for minor known site challenges.
So small and specific.
Yes. However, the source material is very clear on this. Undefined reserves or large, vague, up-your-sleeve reserves are not acceptable. There should be, and I quote, no prizes for having a huge windfall at the end of a job, just because you massively overestimated your costs from the start by building in huge, undefined contingencies.
So transparency and accuracy are key, not just building in secret buffers.
Exactly. The goal is accurate forecasting, which ultimately gives you and everyone else a truer picture of your business's financial health. Furthermore, the advice is that large contingent amounts, even if you think they're justified, should be discussed with senior management before being included. Get oversight, get buy-in, ensure it aligns strategically. Don't just bury it in the numbers.
Okay. This level of detail in forecasting sounds, well, intense, but clearly essential. But what happens if, despite all this effort, a job's forecast actually changes mid-project? And let's be honest, in construction, that's not exactly a rare event, is it?
Chuckles. No, it's pretty much the norm for many projects. Material prices spike, a sub goes bust, you discover something unexpected.
So how does that impact everything we've just discussed, especially our current month's profitability? Does a change in the future forecast hit us now?
Yes, it does. And this is a critical point to understand. If a job's overall forecast changes, particularly the forecast cost or margin, the total to-date change from the previous month's forecast will directly impact the current month's result through the WIT calculation.
Directly impacts the current month.
Directly. This can have a significant effect, as the source puts it, on that month's overall financial performance. It highlights the extreme sensitivity of your current financial statements to ongoing forecast accuracy. You feel the financial impact immediately when the forecast changes.
So if our projected costs for the whole job suddenly go up, or our expected overall margin shrinks, that hits our profit and loss account right now, in the reporting period when we identify and update that forecast, even if we haven't spent the extra money yet.
That's exactly right.
Can you give us a really clear, maybe step-by-step example to illustrate that? Because that immediate impact sounds potentially painful.
Okay, let's use an example drawn from the source material to really illustrate this powerful effect. Imagine our house build project again. Let's say in month 1, your team puts together the forecast for the entire job. Total contract revenue, $260,000. Total forecast costs $200,000. That gives you a healthy overall forecast margin of $60,000, right?
$60 K expected profit overall. Looks good.
And at the end of month 1, you look at your to-date figures. Let's say revenue earned to date is $80,000 and costs incurred to date are $100,000. Based on your percentage complete at that point and that healthy $60,000 total forecast margin, your WIP adjustment for month 1 calculates out to a positive $10,000.
Okay, positive $10 WIP adjustment.
This leads to a recognized margin to date, profit recognized in month 1 of $30,000. So you've earned and booked $30,000 of profit in month 1 for the work done, even if you haven't invoiced it all. Good news, right?
Solid start.
Yeah, absolutely. Looks like the project is on track and earning profit as we go. Now, let's fast forward to the end of month 2. Work has continued, but maybe your team discovers something. Perhaps a significant, unexpected increase in structural steel costs, or a key subcontractor's final bid came in much higher than you originally allowed for.
Okay, reality bites.
Reality bites. So your total forecast for the entire job has to change. The revenue might still be $260,000, but your total forecast cost for the whole job suddenly jumps. It goes from the original $200,000 up to $240,000.
Ouch. A $40,000 increase in expected costs.
Exactly, which immediately drops your overall total forecast margin for the whole project. It goes down from $60,000 to just $20,000. That's a massive $40,000 decrease in your total expected profit for the job compared to what you thought just 1 month ago.
Okay, so the overall profitability picture for the entire job has shrunk dramatically by $40,000 from what we originally hoped. What does that mean for our results in month 2, the current month, even if we haven't actually spent all that extra $40 yet?
That's the killer point. Even if your actual to-date figures in month 2 only adjust slightly, say, your revenue earned to date is now $100,000 and costs incurred to date are $120,000, the really big impact comes through that WIP adjustment.
Why? Because the overall margin dropped.
Precisely. Because your overall forecast margin for the job has plummeted so significantly from $60,000 down to $20,000, your WIP adjustment calculation for month 2 now spits out a negative $10,000.
Wow. From a positive $10,000 WIP adjustment in month 1 to a negative $10,000 adjustment in month 2.
Yes. That's a $20,000 negative swing in the WIP adjustment from 1 month to the next, purely because the forecast changed.
And what does that do to my profit for month 2?
It hits it hard. That swing means your total margin recognized to date for the job goes from $30,000 at the end of month 1 down to only $10,000 recognized cumulatively by the end of month 2. That $20,000 difference, $30K minus $10, is a direct hit to your current month's profitability. The change in future forecast has wiped out profit you thought you'd already booked.
Man, that really drives home how much these ongoing forecasts matter, doesn't it? It's not just a plan. It's directly affecting your reported results now.
Yeah.
For a family business, that kind of immediate financial impact, that volatility, that could be really significant.
It absolutely is. That $40,000 increase in the total forecast cost directly translated into a $40,000 decrease in the total forecast margin. And because WIP adjusts the profit recognized to date based on that overall project profitability forecast, that shift from a positive $10 WIP adjustment to a negative $10 adjustment created that $20,000 negative swing in the monthly result. It directly impacted the reported margin to date.
It vividly demonstrates just how sensitive your current period's financial results are to accurate and regularly updated job forecasts.
That's why managing these forecasts isn't just some abstract accounting exercise. It's a critical, real-time project management responsibility. It directly affects your bottom line, your company's perceived performance month by month.
Okay. That example truly hammered home the immediate and sometimes pretty brutal impact of forecast changes. Now, another area that always seems to cause headaches for project managers, especially in construction, variations. Those changes to the original contract scope. How do we treat variations within this whole WIP framework, both for the revenue side and the cost side?
Variations. Yes, the bane of many a PM's existence, but also where extra profit can sometimes be made or lost. Variations are essentially increases or sometimes decreases in a job scope from what was originally tendered or contracted. And usually an additional amount can be claimed from the client for increases, or maybe a credit is given back if the scope is
Which is
reduced.
almost inevitable, right?
Almost inevitable on many construction projects, but they come with very specific rules for financial recognition, especially within WIP, to avoid, inflating your figures based on hope rather than reality.
Okay, so let's talk revenue first. When can I actually include the revenue for a variation of my forecast? Can I just put in any claim I'm hoping to get approved or any negotiation I'm trying on with the client?
No, absolutely not. That's a classic trap. Revenue for variation should only be included in your forecast revenue when one of two conditions is met. Either a formal variation order has been received from the client, you've got the signed paper,
The official approval.
yes, or if you don't have the formal order yet, only when there's a reasonable likelihood that a formal variation order will be forthcoming. There needs to be a strong basis for that expectation, not just wishful thinking.
So no speculative claims.
Definitely not. Our source explicitly states that ambit claims, those speculative, maybe inflated claims you're just throwing out there to see what sticks and try-ons, where you're just testing the waters, should not be included in your forecast revenue, period.
Okay. Be realistic about the revenue. What about starting the work?
This leads to a critical warning in the material for significant positive variations. Ones involving substantial extra work and cost work should not be commenced on those variations until a formal variation order has been received.
Don't start billing it until it's formally approved and you know you'll get paid for it.
Exactly. It's a vital risk management principle. Protect your business. Don't perform potentially uncompensated work, especially significant work. Get it in writing first.
That makes perfect sense from a risk perspective,
Yeah.
especially for a family business, right? Performing major work without a clear, approved path to revenue, that could be incredibly damaging financially.
Hugely damaging.
Okay, so that's the revenue side. Be conservative, wait for approval. What about the costs associated with variations? Do they follow the same strict rules? Do I wait for approval before including the estimated cost in my forecast?
The cost of variations should ideally also only be included in your forecast cost when a formal variation order has been received or when there's that reasonable likelihood it will be. You try to match the forecast cost with the forecast revenue recognition.
Okay, matching principle.
However, and this is a crucial distinction, costs that you have already incurred on unapproved or even rejected variations must still be included in your cost to date.
Wait, hang on, let me get this straight. I might have actually spent money on a variation at place. Maybe I ordered special materials or had a crew do some preliminary work because I thought it would get approved.
Yep.
But if the client hasn't proved it yet, or even worse, has flat out rejected it, I still have to count those costs I've already spent, even if I can't count the corresponding revenue I was hoping for.
That's correct. You have to recognize the cost incurred regardless of the revenue status.
Wow. That sounds like a recipe for a big, immediate hit to your profit on the books, doesn't it? Cost recognized, revenue zero.
It can absolutely be a recipe for that. And it brutally highlights the importance of managing variations proactively. Getting those approvals locked down before you start incurring significant costs is paramount. You recognize the expense as soon as it's incurred, even if the corresponding revenue is uncertain or, worse, denied.
So what's the advice if a variation is rejected, but maybe work has started?
This leads to the very direct, almost blunt advice from our source material. While stating the obvious, any work being performed on variations that have been rejected, and there is no other contractual legal reasons for doing so, should be stopped immediately.
Stop digging the hole deeper.
Exactly. Cut your losses. Prevent further financial exposure on work you know you won't get paid for. Proper, disciplined variation management, getting approvals first, tracking costs accurately, stopping work on rejected items. It's absolutely crucial for accurate WIP calculation and for protecting your overall project profitability. Ignoring this stuff can quickly turn what looked like a profitable job into a serious loss maker.
Okay. This has been an incredibly detailed deep dive, and I feel like we've really covered the core mechanics of WIP, the what, why, how, the impact of forecasts, variations. But, as project managers and business owners, we know the real world always throws curveballs. Theory is one thing, practice is another. What are some of the really common pitfalls, those traps for young players, as the source calls them, the things that someone new to really scrutinizing WIP might easily fall into?
Yeah, that's an excellent way to frame it. Because while the CI plus M formula sounds straightforward, the practical application can be really tricky. And these traps are definitely where many companies, especially maybe smaller or growing ones, can lose money or get their WIP calculations seriously wrong, leading to bad decisions.
So what's trap number one?
Well, one major trap, as we've just been discussing in detail, is variations. Specifically, the challenge of correctly matching their revenue and costs in the right periods. For instance, recognizing revenue for a variation before you fully accounted for its cost, making you look more profitable than you are temporarily. Or, conversely, incurring significant cost for a variation before it's formally approved, hitting your costs without the corresponding revenue. It's incredibly easy to get that timing out of sync and distort your WIP.
Yeah, I can definitely see how the pressures of a project could lead to that happening. What else? What other traps are lurking out there?
Another big one is the timing of accounting cutoffs. Making absolutely sure that all costs and revenues are recognized in the correct accounting period, usually month end, is critical.
Cutoffs. You mean like making sure everything that happened in July gets recorded in July's numbers?
Exactly. Imagine a major subcontractor finishes a big piece of work on, say, the 28th of the month. You might recognize the revenue related to that completed work in that month because your percentage complete went up. But what if their invoice doesn't actually arrive until the 3rd of the next month?
Ah, okay.
If you don't account for or accrue for that subcontractor's cost in the first month simply because the physical invoice hasn't landed on your desk yet, your WIP and your reported profitability for that first month will be artificially inflated. You've got the revenue side, but missed the cost side.
So you need to estimate and book costs you know you've incurred, even without the paper.
Yes, accrual accounting is key here. You have to capture those known costs in the period they relate to, otherwise your WIP is wrong.
And what about things that are genuinely out of our direct control, like slow paperwork from suppliers or subs? I can almost hear project managers listening and groaning about this one.
Chuckles. Yeah, it's a classic pain point. Late or tardy invoicing from subcontractors and suppliers can create a significant trap for exactly that reason. If you don't receive those invoices promptly, or if your system for accruing for them isn't robust, your cost-to-date figure might be understated at month end.
Making your WIP look artificially high, or your profit look better than it is.
Exactly. We saw a case study once where a major electrical sub's invoice for the entire rough-in phase of a building, a huge chunk of cost, was delayed by 2 weeks past the month-end cutoff. On paper, for that month, the project's costs looked artificially low, making the WIP seem great and showing a much higher profit than reality.
Until the bill arrived.
Until the bill arrived. Then it was a nasty surprise, reversing that apparent profit and causing a sudden dip in the next month's results. It's like, driving with half your dashboard warning lights deliberately switched off. You feel good for a while, but disaster might be looming.
Okay. Now, staying on the cost side, how do you deal with the dynamic factors? Like prices going up versus your team maybe getting faster or more efficient on the job.
Yeah, there's a potential trap in balancing inflation versus the learning curve. Throughout a project's life, especially longer ones, you need to realistically account for potential rising material or labor costs due to inflation. Your forecast needs to reflect that.
Right. Costs rarely stay static.
But at the same time, you should also try to factor in potential efficiencies your team might gain as they get more experienced and productive on that specific job or repetitive task. That's the learning curve effect. They might get faster.
So ignoring either one can mess up your forecast.
Exactly. If you don't account for expected price increases on key materials down the line, your initial cost forecast will likely be too low. But conversely, if you don't acknowledge that your experienced crew is getting significantly faster at, say, framing identical units, your estimated labor costs to complete might remain too high. It's a balancing act.
Okay, now, I've definitely heard this next one mentioned before, and it feels like a very tempting shortcut, especially maybe for newer project managers. Just assuming that your cost to complete is simply your original tender cost estimate minus whatever you've spent so far, your cost to date. Is that a trap?
It absolutely is a trap, a big one. That's often a massive oversimplification. Why? Because it implicitly assumes your original tender estimate was perfect, flawless.
Which it rarely is.
Exactly. It assumes there have been no scope changes, unlikely, no unforeseen site conditions, common, no major price fluctuations, and no inefficiencies, or conversely, efficiencies, compared to the original plan. You have to re-estimate the actual cost to complete based on the current reality of the project, the knowns and unknowns today, not just subtract from an old, potentially outdated number.
Okay, re-estimate, don't just deduct. Good advice. Speaking of costs, what about the ones that happen right at the very end? things people might forget about when they're focused on the main build.
Yes, that's another classic trap. Forgetting about the rear-end costs. These are all those costs that often occur right at the tail end of a project, sometimes even after the bulk of the physical construction work looks
Well,
finished.
you mean things like final commissioning of systems,
Hmm.
preparing the operating manuals for the client, getting the as-built drawings done accurately, or even just the cost of demobilization, getting all your equipment and people off the site and cleaning up.
Precisely, all of those. They can certainly add up, especially on larger or more complex projects. If these rear-end costs aren't meticulously accounted for in your cost to complete forecast throughout the job, they can come back to bite you right at the finish line, significantly impacting your final profitability. They can easily turn what looked like a reasonably profitable job into a marginal one, or even push it into a loss unexpectedly.
Easy to overlook, but potentially costly. What about different types of contracts? Are there traps specific to, say, service work?
Yes, the source highlights service contracts, specifically the problematic and often wrong assumption that all revenue perfectly matches costs incurred in any given period. In a dynamic service environment, client needs can change quickly, costs can fluctuate unexpectedly, and revenue might not align neatly with the effort expended in a short time frame. Assuming a simple match can distort your WIP.
And maintenance contracts.
Related to that are the complexities of term and perpetual maintenance contracts. These have ongoing revenue streams and ongoing cost streams, often spanning multiple accounting periods. Applying WIP principles correctly here to accurately reflect the revenue earned versus the costs incurred over time can be quite complex and needs careful handling.
What about after a project is supposedly done and dusted, handed over to the client? Are there still WIP-related traps?
Yes, warranty work is another one often overlooked. The potential cost of post-completion warranty repairs or callbacks, if not properly estimated and accrued for during the main project or accounted for afterwards, can eat into a project's final, true profitability long after everyone thinks it's finished. If you have significant warranty obligations on past jobs, that potential future cost needs consideration, as it represents a potential drain related to that earned revenue.
Right, the job's not truly over until the warranty period expires.
Effectively, yeah. And finally, a couple more related to money held back. Retentions. These present challenges on both sides. Debtors' retentions money owed to you by clients but held back until final completion or defect rectification. And creditors' retentions money you owe to your subcontractors but are holding back similarly. How these are treated in your accounts, particularly around timing and valuation, can impact your WIP calculations and your cash flow forecasting because they affect when cash actually moves versus when revenue or cost is recognized.
And any other specific cost traps?
Just a mention of remembering special job-specific costs, things like needing unusual expensive insurance cover just for one particular high-risk project, or maybe bespoke permits or fees that only apply to that one job. These can easily be forgotten in broader cost estimates if you're not careful, but they absolutely must be factored into that specific job's cost forecast and WIP calculation.
Wow, that list of traps really underscores the need for constant vigilance and really detailed financial management, doesn't it? It's not just about the basic formula.
Not at all. It's about understanding the nuances and potential pitfalls and applying it consistently and accurately in the real world.
Okay, this entire deep dive has painted a really clear picture of WIP's importance, its mechanics, its complexities, and those traps. But stepping back a bit, beyond the calculations and the pitfalls, what are some of the broader, maybe other issues that business owners and project managers really need to keep top of mind when it comes to work in progress, particularly perhaps for a family business where maybe things have been done a certain way for a long time?
That's a good perspective to take. One of the most significant other issues to highlight is the knock-on impact on your key performance indicators, or KPIs.
How so?
Well, think about it. If your WIP calculation is materially incorrect, either overstated or understated, then other really important financial KPIs, the metrics that you, your management team, your bank, maybe potential investors rely on to assess the health and performance of your business, they will also be incorrect.
Because WIP feeds into the profit calculation.
Exactly. WIP directly impacts your reported profit. So this inaccuracy will ripple through and distort critical metrics like EBIT, that's your earnings before interest and taxes, a core measure of operating profit. It'll affect EBIT to earnings before interest, taxes, depreciation, and amortization, often used as a proxy for operational cash flow. It can distort NOPAT net operating profit after tax, another key measure of profitability from your core operations. Even things like earned revenue per employee or profit margins. They all get skewed if the underlying WIP number driving the profit is wrong.
So getting WIP right isn't just about getting one number right on the balance sheet. It's fundamental to the integrity of all your key financial performance metrics, which, in turn, inform pretty much every strategic decision, from investment choices to staffing levels to borrowing capacity.
Precisely. You could be making major decisions based on flawed data if your WIP isn't accurate. This just reinforces, again, the absolute critical importance of correct allocation of costs. If costs aren't accurately assigned to the right jobs in the first place, or if they're misclassified, maybe direct job costs accidentally getting lumped into general overhead, or vice versa, your WIP will inevitably be distorted, and consequently, so will your profitability analysis, your KPIs, and your overall understanding of where your business is actually making or losing money.
Okay. What about the culture around reporting this stuff, especially if the news isn't good?
That's another crucial point, particularly, I think, for family businesses where relationships and maybe a desire to avoid conflict can sometimes complicate things. The guidance is very clear. Bad news should be highlighted and properly investigated immediately.
No sweeping things under the rug.
Absolutely not. It means fostering a culture from the top down where project managers feel safe and are actually encouraged to report potential losses, significant cost overruns, or major forecast deteriorations as soon as they are identified, rather than, trying to hide them, hoping they'll magically resolve themselves, or waiting until the end of the job when it's too late. Proactive problem solving, based on timely and honest reporting, is essential for mitigating damage and, just as importantly, learning from mistakes to improve future performance.
And on that note about honesty and reporting, there's a very strong statement in our source material about ethical conduct here, isn't there? Which feels vital for any business, but maybe especially for one where family reputation and legacy are on the line.
There is. It delivers a really strong, unambiguous warning. Deliberate manipulation of costs from bad jobs to good jobs is strictly forbidden. Full stop.
So no shifting costs around to make one project look better at the expense of another.
Absolutely not. This is not an area for creative accounting or trying to smooth over problems artificially. The source material makes a very clear and I think very fair distinction that's important for any manager to understand and communicate. No one will be sacked for making honest estimating or project management mistakes, providing they are not continually recurring.
Okay, so honest mistakes are forgivable, part of learning.
Yes, that creates a psychologically safe space for genuine errors and for people to learn and improve within the team. However, it then states, very forcefully, however, the deliberate manipulation of job costs is clearly a sackable offense. And it even attributes this, adding weight.
Whoa, a sackable offense. That's serious.
It reinforces the absolute necessity of ethical conduct and professional integrity in WIP calculation and reporting. It's about transparency. It's about honesty in reporting your financial performance. Because ultimately, your financial statements are a fundamental representation of your company's integrity to the outside world and to yourselves.
That's a powerful statement, really reinforcing the serious nature of this responsibility. And finally then, what about accountability within the organization? Who is ultimately responsible for getting all this detailed WIP calculation and forecasting right? Is it the accountant? The project manager? The owner?
The short answer is, managers are accountable for all jobs under their ultimate control.
The managers overseeing the projects.
Yes. Now, they can and often should delegate the task of detailed job forecasting, collecting the cost data, estimating the cost to complete to the respective supervisors, project managers, site engineers, the people running the jobs day to day who have the closest knowledge.
Okay, delegation makes sense.
But, and this is the crucial part, despite that delegation of the task, the managers are still ultimately responsible for the accurate calculation and reporting of WIP for the jobs under their overall purview.
So the buck stops higher up.
The buck stops with management. This establishes a clear line of responsibility and ensures that those with the oversight authority are also held to account for the financial health and the accurate reporting of the projects under their charge. It means, if you're a project manager, you might rely on your site supervisor for input on percentage complete or costs incurred, but you are ultimately responsible for the accuracy of the WIP figure you sign off on for that project. And if you're the business owner or general manager, you're ultimately responsible for the overall WIP picture.
Wow. Okay. This has truly been a deep dive into work in progress.
Yeah.
We've gone from thinking of it as maybe just a confusing number the accountant deals with, that black box concept, to, I hope, a really comprehensive understanding. And it seems crystal clear now that WIP is, well, arguably one of the most significant items on your balance sheet,
Mm-hmm.
especially if you're in construction or project-based work like many family firms are.
Absolutely significant.
It has that direct, immediate impact on your reported profit, which, let's face it, is the lifeblood of any business. And consequently, because profit feeds into equity, it significantly affects the net worth of your company, which directly relates to the long-term stability, the value, the success of a family enterprise.
Couldn't agree more. And it's not just a backward-looking number on a page either. As we've seen, it serves as a vital management tool
Mhm.
for ongoing monitoring, for review of your past performance, your present situation, and even planning your future work and capacity.
It really is. Now, we have to acknowledge, as we've discussed, it can be difficult to quantify accurately. There are judgments involved, forecasts, estimates. It's certainly trickier than counting the cash in the bank or tallying up your debtor's ledger or valuing fixed assets like trucks and equipment.
Definitely more subjective elements, yeah. Which makes the process and the discipline around it even more important.
But the consequences of not putting in that effort, of getting it wrong, they can be severe. As our source material warns right at the end, and it's worth repeating, it can have disastrous consequences if we get the calculation of it materially wrong.
Disastrous is a strong word, but probably accurate in some cases. Misleading banks, making bad investment decisions based on flawed numbers, paying the wrong amount of tax, running out of cash because you thought you were more profitable than you were. It can really sink a business if WIP is fundamentally wrong.
So understanding WIP isn't just about good accounting. It really feels like it's about robust business management, about having strategic foresight, and ultimately about safeguarding your company's future, your family's legacy.
Well said. It underpins so much.
Okay, that's a powerful and maybe slightly sobering thought to end on. But let's try and turn it into action for you, our listener, especially if you're running or managing one of those successful construction or project businesses we talked about at the start. Now that you hopefully have this much deeper understanding of WIP from what it is, how it's valued, the impact of forecasts, the common traps, those critical ethical considerations.
Yeah, hopefully it's less of a black box now.
We really challenge you to consider WIP not just as some compliance chore your accountant handles, but as a potentially powerful diagnostic tool for your business. Think about it. What's maybe one area of your current project management or financial reporting that this deep dive has eliminated for you?
Yeah, has anything sparked an idea? Maybe you'll look differently at your project forecasts from now on, or maybe scrutinize those variations a bit more closely before starting work.
Or perhaps just feel more confident having a more informed conversation with your accountant, your bank manager, or even your own team about project profitability. What specific action, however small, or what conversation might you initiate this week, armed with this deeper understanding of WIP?
Even just asking for that WIP summary report we discussed could be a great first step.
Absolutely. Take that first step towards more informed, more proactive financial management in your construction business. It can make a real difference. Thank you for joining us on the Deep Dive.